Namaste students. I heartily welcome you to this lecture session, and in this lecture we are going to discuss the basic terms in accounting. Accounting is understood to be the language of business. As a language, we have some special characteristics for this accounting. We have got some unique terms to understand, which we will be using with specific meaning and understanding in our subject. So, this lecture would attempt on discussing the various terms that are being used in accounting as a language of business, and we will try to learn as its usages in various aspects. So, let's proceed to start with understanding a million-dollar question. What is accounting? Accounting is understood to be the process of recording, classifying, analyzing, and interpreting the business transactions, which can be measured in terms of money. So here, what is the major objective of accounting? It is to keep a permanent record of all the business transactions. These records also are to be kept in a systematic and scientific manner, so that the purpose of comparison is also served. So here, accounting helps us not only to know the profit or loss position at the end of a given accounting period, it also helps us to know the correct financial position of the business unit at the end of the provided accounting year. So we understand that accounting provides all necessary valid information, especially the financial information, to the necessary parties of the business enterprise. It could be both external users or the internal users. For instance, could it be to the owners, to the bank, to the customers, to the government, even to the outside parties. And why do we require this financial information? We need this financial information in order to make valid decisions. So, this accounting provides us with the financial information necessary to make the required judgments and to make the necessary decisions by the top level management. Now, here comes our first step in understanding this language of business. Let's learn as to some unique terms, specific terms that are exclusively spoken in our subject. The first of its kind, entity. What does entity mean? Entity exactly means existence. It refers to the presence of a particular thing. So here, when I use this word entity, there is an existence. Rather, I can also go a step further and say there is a physical existence, a tangible existence. Now, when I speak of business entity, the business entity denotes an enterprise or a business unit that carries out various transactions in terms of money which exists. So, there is an existence for the business unit. Business entity also means that the individual is different from that of the business what he is conducting. This is popularly referred to as business entity concept. All this accounting, that is the recording of the transactions, right from starting off the recording of the transactions till ascertaining the financial position of the business, the entire gamut of accounting revolves around this business entity concept. So we go with an understanding that the business unit established by the individual is different from that of the individual itself. So, entity refers to an existence and business unit are bestowed with an existence. Now, as per law, this existence aspect differs. It depends upon the type of business organization, whether the law recognizes this entity or not. For instance, sole proprietorship and partnership do not enjoy a separate business existence. That is, there is no distinction as per law when it comes to the individual and the business units. They do not enjoy a separate legal entity. Whereas the joint stock companies and cooperative societies, they are given a separate legal entity. When it comes to a normal entity, what we are speaking in terms of business language, every business unit enjoys a separate existence. So I can say that each and every business enterprise established does enjoy the entity aspect according to accounting. Entity also means an economic unit which performs the economic activities. So any kind of name you take, for instance, Bajaj Auto, Maruti, Disco, HAL, BHEL, even the name of our college, MES College, all this refers to entities. So the names of the business organization give us a reference to the entities. Whatever be the form of the business organization that is being conducted, the business enterprise refers to an entity. Only on this entity that the basic recording of the transactions could happen. You know that capital has to be invested into the business. So here, how do we define this capital being invested is the individual is going to give the capital to the business entity. Which means when you are recording from the point of view of the business unit, capital has to be entered as a liability. Liability refers to all that what the business owes to the outsider. So here capital is considered as a liability for the business unit with an apprehension, with an assumption that business is different from that of the individual conducting it. So entity concept is very, very important to learn the subject in a better manner. Then comes the word transaction. Transaction is any event or any activity which includes the exchange of money or money's worth between two separate entities. Just now we understood what an entity means here. So when you speak of entity, there should be a minimum of two entities where the exchange of the money worth or money happens. It could be the selling of the goods, purchasing of the goods, purchasing of an asset, or even payments done. So whatever we refer to as an activity, but it should involve money or money's worth, quantifiable in terms of money. And rather even I could say that it should also have an intention of making profit. So any activity that is done between two entities, two sets of people, for money's worth, which includes the exchange aspect and which is being done with a motive of earning profit, is what we call it as a transaction. So you understand that the transaction cannot happen with just one party's presence. There should be two different parties to enter into a transaction. And it should be quantifiable. What cannot be expressed in terms of money cannot be a transaction. When I say I placed an order for the supply of goods, it is not a transaction. Though it specifies placing an order, maybe I would even certainly say the worth of the money for which I have placed the orders. But then there is no activity or exchange that is happening. There should be an element of giving and receiving benefits by either parties in a transaction. Then only that the transaction is said to be done. Every transaction can be subdivided into two kinds. It could be either a cash transaction or a credit transaction. A cash transaction is one where the exchange of the value of money or the cash happens at the same point of time when the exchange of the other aspect, either goods or assets, happen. The cash transaction marks the completion of the transaction at a single period of time. On the other hand, if the exchange of the value of cash is incomplete at a given point of time, we call it as a credit transaction. Let me cite an example to make you understand the difference between a cash transaction and a credit transaction. Now there are two parties, A and B. A purchased goods from B. In this transaction, let us take the money worth to be rupees 5,000. So when A purchased goods worth rupees 5,000 from B, A gets the delivery of goods from B, and also he has to make the payment of 5,000 to B. When both these aspects are complete at a given point of time, we could say that this is an example for cash transaction. On the other hand, in the same transaction, A purchased goods from B on credit worth rupees 5,000. So here, A purchased goods worth B, wherein goods are delivered to A. A has received the delivery of the goods, but he has not made the payment. He is yet to make the payment, which is postponed to a different future period of time. So in this case, one part of the transaction, that is delivery of the goods, has been completed, but the payment has not been done in the same point of time, which is postponed to a future date. This is an example of credit transaction. So the transaction can either be cash transaction or a credit transaction. But remember students, both these transactions are done with the motive of earning profit. Now what are the basic characteristics of any transaction? It should be expressed in terms of money. So it could have money or money is worth, but it should be expressed in terms of money, meaning quantifiable. And it should also include the exchange of the goods or services. Without this, we cannot say that it is a transaction. And certainly it arises out of the transfer or exchange of goods and services. So when you do a transaction, we find that there is a change which happens in the financial position. Meaning the assets and or the liabilities of a business might face a change. When you buy goods, when the goods enter the business, you know that goods are a part of the assets. And the value of the goods increases, thereby we say the value of the assets also increases. So whenever a transaction happens in a business, also it indicates a change that is brought about in the financial position, meaning in the assets or the liability positions of the business. And every transaction comprises of two aspects. One would be the receiving aspect, the other would be the giving aspect. So when there are two parties in a business concern, when there are two parties doing this transaction, one party would be at the receiving end, the other party would be at the giving end. So no two parties will receive at a time or give at a time, because the motive of earning profit would be happening only when one party receives something at the same time that he is going to give away certain other things. So the receiving and giving aspects are there in a transaction to give it a complete aspect. So here the receiving aspect is usually referred to as the debit aspect, and the giving aspect would be referred to as a credit. But then this will not sit into every time when you discuss the transaction. Debit and credit are understood to be the operative words. So they keep changing their meanings as and when we are going to use them, that you will be learning in the next part of your lectures. So transactions can either be the cash transaction or the credit transaction. So I hope you would have understood what is meant by a transaction, what are the two kinds of the transactions that we do in a business, and how the transaction comprises of the receiving and the giving aspects. Now let us move into certain other terminologies that are popularly used. Now when you take a business enterprise, normally as I told you that it comprises of transaction, and transaction indicates the exchange of goods and services. When I use the word goods and services, goods is the term which is used to indicate anything that is meant for sale in the business. Now, these business activities, meaning the exchange of goods and or the services, would fetch us a certain money back. And this is what we term to be sales, the revenue from operations. What do you mean by operations here? The sales is referred to as the major operation of the business, which is revenue seeking. So here the revenue from operations of the business. When you do selling of the goods or services, the business gets money, and this money is what you popularly term it to be the sales. But then revenues does not comprise of sales alone. Revenue indicates all the returns that comes into the business unit, and it could be through sales. Sales is considered to be the normal business revenue activity, revenue seeking activity. But then you can also have a certain other aspects, like for instance, you would have been owning a very big building, only a portion of the building that you are using it for your business purposes, the rest of it is going to be let out. So there is some rent that you receive. It is not your course of the business activity. Letting out is not your business, but you are letting out because you are having a surplus portion of the building. So the rent received is a non-business income, but that also forms a part of your revenue. So revenue in business has two aspects. One is the revenue that you receive out of the regular returns, which you get out of doing a regular business activity in terms of selling of the goods. This is what we call it as sales, or otherwise popularly termed as revenue from operations. Other than that, if the business is earning money out of any other activities in the business, that is, we term them as non-business activities, that also forms a part of the revenue of the business. This would get included in the revenue aspects. Moving on to the next word, assets. When I say assets, assets refer to as utilization of funds. Any business gets started out of a certain money investment, which we term it as capital. This capital needs to be invested. In some form of the other, you have to make use of this capital in order to do business activity. So what exactly are you going to do with this capital? What exactly are you going to buy or retain in the business to do the business activity is what you call it as assets. So assets are resources owned and controlled by the business enterprise. I have invested 1 lakh rupees. What am I doing with this 1 lakh? I have invested this in the bank, or rather I have deposited it into the bank. Cash at bank is an asset. One fine morning, I have decided I am going to start a stationery shop. So I went and bought a bulk of goods, paying 25,000 to the wholesaler. The books what I have got into the business are my assets because I own them and I have kept them for an immediate sale. And similarly, you have the resources owned and controlled by the business enterprise. The utilization part of your resources is what we term it as assets. So examples of assets could be land that you own, machinery, furniture, even including the goods you buy to be sold in your business enterprise. Could it be your cash in hand, cash at bank? All these become the examples for the assets. Let us also understand that these assets are of different types. We can categorize them into fixed assets, current assets, investments, and so on. Fixed assets are those assets which remain in the business for a very longer period of time. When I say longer period of time, it is an understanding a kind of that it remains in the business for more than 1 year. Usually 1 year is taken as the standard measure in accounting. So the assets which remain in the business for more than 1 year's period of time, we can term it as fixed assets. And remember, these assets are not meant for immediate sale. Why does the business unit buy them? They buy them for the basic infrastructural development. That is, these assets are kept in the business for improving the profit position, not for selling them immediately in the market. So examples of these fixed assets could be land, building, plant and machinery, furniture, etc. On the other hand, you also have the category of current assets. Current assets are those assets which are acquired by the business unit to maintain or do the day-to-day business activities. In fact, they are such an assets which could be converted in the form of cash or cash equivalents within a period of 1 year. You have a different possession of the goods. For instance, certain goods you buy. In the previous example, I told you that I need to start a stationery shop. And what am I going to do? I'm going to buy certain books for sale. These books I categorize them as assets. They can be called as current assets. Why current assets? Because when I sell these books in the market, I get money. The assets which can be converted in the form of cash or cash equivalents, which can be, it doesn't mean that you have to convert it. You have to be very cautious on understanding the meaning of each one of these words. The assets which are capable of being converted into cash or cash equivalents within a period of 1 year is termed to be a current asset. So in this manner, we can give examples of the current assets, including inventories. Inventories refer to the stock of the goods that we have in our business. It can be the stock of raw materials, it can be the stock of work in progress, and it can also be the stock of finished goods. It depends upon the kind of entity you are talking about. If it is a production unit, then you would have all these raw materials and work in progress. If you are talking about trading units, then we only deal with the finished goods. Cash balances, cash in hand, cash at bank, debtors, the set of people from whom the business has to receive a certain money. And it could be bills receivable. All these are termed as examples of current assets. Investments. When a business enterprise wants to invest its surplus funds, it can do so, and it can do this investment part in the external activities or the external options available. For instance, the business unit can buy the shares issued by some other companies. It can also buy the government bonds, or even some fixed deposit can be kept in any bank for safety and certain return purposes. All these refer to investments. So why does a business unit has to invest its surplus funds? It has to do so because it will fetch a certain amount of interest, the returns. And if you buy shares, the companies will give you dividends. Dividends are a form of returns to us. Our stabilized returns will come to our business unit. For this purpose, the business units would generally opt for investing its surplus funds. If that surplus funds are invested in our own business, then it becomes capital. Obviously, that money what we invest in our business would be termed as capital. But in case if we are opting to invest it in the outside activities, just like how I told you, to buy shares of different companies or to deposit it in the banks, in such cases, these are referred to as investments. So investments in the normal way, they will fetch you the returns either in the form of interest or in the form of dividends and so on. But then in the long run, in case if there is an option that you want to sell these investments, during the sale of the investments, you can either face a profit situation or a loss situation. If the market is doing good, then naturally when you sell this investment, you would definitely get a very big money as returns, which would be a capital profit for your business enterprise. On the other hand, in case if you sustain a loss, then the business would have to face a loss on the sale of the investments. So it depends upon the saleability. But then remember, investments are categorized as assets. So they are not meant for immediate conversion. Only investments are done by the business unit for safety purposes, and they increase the financial health of the business, and they are not meant for immediate sale. But I just mentioned you that in case if there is a situation where it needs to be sold, then the business unit might face either a profit or a loss when the investments are being sold. So we have looked into some of the basic terms in accounting. There is a very long list of such words which are repeatedly used in our subject. So let me continue with a few more lecture sessions on helping you to understand these kinds of terms that we use very often in our accounting subject. Thank you for that patient listening of the lecture, and I hope you will repeat listening to this lecture so that you are able to get an idea as to what explanation that I gave for each one of these words. Thank you. Have a wonderful day.